Okay, what is the first thing that comes to your mind when you think of your health insurance? All right, let's go with your second thought because we want to minimize foul language in this podcast. So I'm guessing whatever you're thinking, whatever your first reaction was, the common theme is we are paying too much. Well, it seems like costs are out of control, doesn't it? But if you dig into the data, insurance premium inflation is relatively tame compared to other sticky parts of CPI. What makes it feel out of control isn't necessarily the price trend, it's the value. We're paying more and getting less for our premium dollars. That's pretty clear. Let's look at United Health Group, the largest private insurer in the US. Since 2005, their gross margins have fallen from the mid-20s to about 18% today. Why? Because provider costs are rising, and you guessed it, drug prices are climbing too. Now, who supplies United Health? Well, Cardinal Health. It's one of the biggest distributors in the business, but Cardinal's gross margins, well, they're barely scraping 3%. Back in 2009, margins took a huge hit when they spun off CareFusion. They bounced back a bit into the mid-teens as blockbuster drugs came off patent, but since then, the trend has been straight down. And who does Cardinal buy from? Well, the who's who of Big Pharma, that's who. Think about AbbVie, Johnson & Johnson, Bristol Myers Squibb, Eli Lilly, Pfizer, Novo Nordisk, Gilead, Amgen, Roche, and Merck. And that's their top group of suppliers right there. Some of the biggest drugs out there are in this mix of providers. Think about Skyrizi for psoriasis, Stelara for Crohn's, Eliquis for blood clotting, Mounjaro and Ozempic for blood sugar and weight loss, Prevnar for pneumonia, Biktarvy for HIV, Enbrel for arthritis, Herceptin for breast cancer, and Keytruda for just about every form of cancer known to man. These are household names because they are life changers and because the commercials are impossible to miss. And these numbers aren't small numbers. Trust me. Bristol Myers sold $20 billion of Eliquis last year. Novo Nordisk pulled in $17.5 billion on Ozempic alone. And Merck, $29 billion on Keytruda. Now, developing these drugs is expensive. It takes years of trials, regulatory battles, and a fortune in R&D. By the time a blockbuster hits the shelf, the company may only have 8 to 12 years of true patent protection to make its money back, satisfy shareholders, and build a moat. And that's why AbbVie, just to pick one, has a gross margin that has climbed from 70% to 83%. Yes, 83. Think about that. United Health is making 18, Cardinal is making 3, AbbVie is making 83. So could AbbVie lower prices and still be profitable? Of course they can, but why would they? This is capitalism. Their job is to maximize profit, period. If AbbVie lowered prices, maybe insurers can cut premiums or offer more benefits. But again, why would they? This is capitalism, and you know the rest. So if you really want to fix the cost structure in American healthcare, it's obvious where to start. That would be Big Pharma, and they hold all the cards. Who is the biggest insurer outside the private sector? Well, that would be the US government, Medicare, Medicaid, CHIP, and VA. Together, they represent massive buying power and a massive line item in the federal deficit. No wonder both parties dream about taking a bite out of drug prices. Lower prices help consumers and they shrink the deficit. But here's the twist. AbbVie sells almost half of its drugs outside the US. And guess what? American buyers pay 2 or 3 times more for the same meds. Why? Because foreign governments negotiate as monopsonies. That's a single buyer with all the power. The US system is fragmented. Insurers are split up, the government is slow, and Big Pharma uses America to subsidize cheaper prices abroad. Enter politics. President Trump has been threatening to force parity for years, and yesterday, he got a win with Pfizer. The deal is simple enough. Pfizer slashes prices by up to 85% through a new government platform. They're calling it TrumpRx.gov, though that may not be the ultimate name. Medicaid gets most favored nation pricing, meaning American taxpayers won't pay more than France or Germany or Japan or Canada. In return, Pfizer gets a 3-year break on new tariffs and agrees to invest $70 billion in the United States. So what does that mean? Well, it means that Pfizer is being forced into global price parity. And if Pfizer wants to keep its 80% margins, it will have to raise prices abroad. Americans pay less, foreigners pay more. Capitalism is happy. Is this a win-win? Well, sort of. Consumers in the US win. Pfizer wins, private insurers certainly win, and the government also wins. The losers are, foreign healthcare systems that have been getting a subsidy courtesy of the American consumers. This is economics in action, my friends. Price parity is when the same product costs the same across all markets after currency adjustments. It's what the textbooks say should happen, but sometimes it needs a little push. So was yesterday a win for Trump? Maybe, but it was definitely a win for economics. So your truth bomb for today is this. If you want to lower healthcare costs, you don't start with insurers or distributors. You go straight to the source, Big Pharma's margins. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.